Any time a year is ending and another one's about to start is a prime time to evaluate your investments and make some smart year-end investing moves. The two actions I explain in this video can help you cut your tax bill and can set you up to improve your investing returns in coming years. Hi everyone, welcome to Money Answers TV. I'm Jordan Goodman, America's Money Answers man. I want to help you improve your financial well-being with great information and insights so you can take on everyday financial challenges, like making the smartest year-end investing moves. The first step to take is to balance your investment gains and losses. It's been such a strong year in the stock and bond markets that chances are you've experienced strong investment gains in your portfolio. If you've sold stocks for a big gain, you can counteract that by selling stocks in which you have a loss to offset that gain. You should match short-term gains that you took by selling stocks you've held for less than a year with short-term losses. Match long-term capital gains on stocks you've held for more than a year with long-term losses. If you have losses that exceed your gains, they can use up to $3,000 in losses to offset ordinary income. Any losses of more than $3,000 can be rolled over to offset gains in future years. If you own mutual funds, it's likely that the funds will distribute both long and short-term capital gains to you sometime in December. If you hold those funds in a taxable account, you'll have to pay taxes on those distributions, even if you reinvest them like most people do. You will get a Form 1099 in January, which will tell you how much your gains are that are going to be taxed on. So don't be surprised if you have to pay taxes on gains and you don't have the money to pay them because you reinvested the distributions. If you're thinking of buying a mutual fund in December, wait until after the distribution is made so you don't have to pay tax on a gain that you didn't experience. The second step to take is to see how your assets are allocated between stocks, bonds, and cash and rebalance them. Say you start at the beginning of the year wanting 70% stocks, 20% bonds, and 10% cash. If the stocks have soared in value, you may now have 90% in stocks and only 10% in cash and bonds combined. To get back to the balance you want, you have to sell stocks and buy cash and bonds. That may be difficult to do because you're selling your winners and you're buying the assets that did not do as well this year. Taking those two simple steps of offsetting gains and losses and rebalancing your assets at the beginning of the year can not only cut your taxes, but they can set you up for investing success for many years to come.